Hello, this is David. Welcome to the next chapter of Andrew Ng's excellent textbook, Asset Management, A Systematic Approach to Factor Investing. I hope that you viewed the previous video, which was on Chapter 6. So that was the previous chapter. Chapter 6 was called Factor Theory, because that was the theoretical introduction to this Chapter 7, which is called Factors, and discusses some of the concrete factors, the factors that are popular or common or have been well studied. So that factor theory in the previous video, if you took away one thing from that, I hope it would be really Ng's definition of a factor, which can be counterintuitive. Remember, factors are bad things. And so they are the premium, the return that's earned due to exposure to a factor is because there is an expectation that there will be a loss during bad times. So one of the most common phrases in that throughout his textbook is bad times. Factors give compensation to investors for what is experienced during bad times. A low beta stock has a low beta and a lower expected return not because of its positive attributes, but really because under this theory, a low beta stock experiences less of a loss during bad times. A high beta stock would have higher return because it is expected to experience more of a loss during quote unquote bad times. So now we're into a discussion of some of the concrete factors, and we have 5 learning objectives. You can see they're all qualitative. We don't yet have computations to do in Andrew Ng, so I think that's a pro and a con. A lot of theory continues. And so we start with describe the process of value investing and explain reasons why a value premium may exist. I'm going to pull up my pen here that I am still learning, and I'm going to just try and draw the PE ratio just in case it helps to know how I was taught this. But first, in terms of Ng value stocks, he says are stocks whose prices are cheap in relation to their net worth. I added intrinsic value because I think that's a common comparator as well. The point there with a value stock, by the way, I can't help it. I'm a value investor. I'm a deep value investor. So this here is my thing. The idea is we want to buy stocks that are cheap in relation to their intrinsic value, or however you want to measure that, different ways to measure that. Ng tends to focus on accounting book value. Others would classically say the intrinsic value is a function of the discounted expected cash flow of a company, or even the economic value added when we consider the true cost of capital. Lots of ways to look at the true or intrinsic value, but a value investor is basically trying to buy that stock cheap. And so another way to look at this is the PE ratio. When I was taught, I thought this was handy. PE ratio, that's a value metric. The value investor is sort of focused, if not obsessed, but prioritizing the numerator, the price that I'm paying for the stock. A growth stock are stocks whose prices are costly relative to their book value, and so the ratio of their book value to market value will be lower. So Ng is introducing this in terms of a classic factor we'll see in Fama French. We'll see why it's put this way, but the way that I was taught is that a growth investor is primarily interested in the denominator. They want to see companies who are growing the earnings. And they may look at price, but if it's expensive, that's secondary. They really want high growth companies. And in fact, it's been a very successful strategy depending on the market regime. And so value investing could be the process of going long the value shorts and short the growth stock if you're including the full set opportunity set.